All right, let's welcome in Matt Orton, Chief Market Strategist at Raymond James Investment Management. Matt, good to have you with us here. Good morning. Thank you for joining us. I mean, I think what the Treasury Secretary said that, I don't know if you heard that soundbite we played out. This was in an interview with CNBC last night. He said, well, I have, the information flow is asymmetric. I have information, so I'm very confident. You don't have it. Markets don't have it. So you're kind of nervous. And he said, well, some deals could come as early as this week. But even as that may be the case, Matt, do you think markets generally have run up and kind of have repriced completely? I mean, recouped all losses since the April 2nd Liberation Tariff Day. So now you're going to run into some hard data. Even as news flow gets better on tariffs, headlines get better, markets have recovered. What's your sense?
Hey, good morning, Prashant. It's always great to join. And that's really the key question I think a lot of investors are trying to digest is, to what extent will we see the hard data start to roll over? I don't think anyone would argue, I certainly wasn't arguing coming into this year not knowing anything about what tariffs were going to look like, that economic data was going to slow because it had been so high for such a long time, and we knew we were going to be pulling back some fiscal spending in the US. Tariffs obviously accelerate that. What I think is critical, though, and what Bessent has been alluding to, is that the administration has been listening to the markets. The administration has seen the market reaction to, I'd say, some of the worst inclinations or the negotiating tactics, per se, of tariff policy. And you're seeing those left tail scenarios be removed. We're finally talking about trade deals. I'd love to see some of those trade deals get signed. I think perhaps India, Japan, South Korea are probably going to be amongst the first ones that we see. But that at least, I think, gives a signal that the tariff policies as it stands and as we're likely going to get to, in and of itself, isn't enough to drive the economy into recession. I think that's reflected in the strength of the hard data that we're seeing. And from the market perspective, a lot of companies that are tied to the technology sector, a key part of the overall market, remain in really, really good shape. We've seen great earnings, and they haven't pulled their guidance. They've actually maintained or increased their guidance going forward.
Matt, hi. Great to have you on. So in the midst of all this uncertainty, what's the sense? Broadly, do you see the U.S. market heading higher? I mean, it now believes that some shape and form of these deals will start coming through. So from a market standpoint, is the direction still up for the U.S. and then markets like India?
Yeah, it's a good question, Surabhi, and I think you want to look at it in two phases. Number one is what's going to happen in the short term. And in the short term, I'm a little bit cautious. Short term meaning the next couple of weeks to a month. And that's largely because a lot of good news has already been priced in. We get the FOMC on Wednesday, as you mentioned earlier in the program. And I think that can be a catalyst to maybe have the markets pause for a little bit and say the Fed is not here to come to the rescue should we see hard data start to roll over. So I think the bond market has some repricing to do. I think the rate cut expectations are too high. And I think that could lead to maybe some sideways movement, some consolidation. And that is a good opportunity for long-term investors to start to use opportunistically. Because as you know from our conversations over the past few months, I'm very glass half full with respect to where the economy and the market can go over the next year plus. I think earnings will continue to be strong, but the key message that I give to clients when using downside opportunistically is that this isn't a market that you want to buy as the market. You want to lean into specific stocks, specific sectors where there's durability with respect to earnings growth. And I think that applies to markets like India too. A lot of good news has been baked into the Indian market. I've been encouraging clients to use India as a ballast in portfolios, but a lot of the high quality names that have been my favorite picks over the past year that I've really leaned into in weakness, these high quality names have reported great earnings. And I think the outlook looks very, very bright. So I'm still encouraged by India. I don't want to chase the upside. I want to let the market come to me so I can continue to slowly and opportunistically add.
All right. Hi, Matt. Always good to hear your thoughts. Well, as you have mentioned in the past, India is your preferred market, but stocks is something that you like. So give us, first I want you to comment on the European markets. Last night I was just pulling out some data with regard to how equity markets are, how far away are they from all-time highs. And the DAX was 0.5% away from those levels. So the European markets clearly have bounced back. What's your view on the European markets? And since you spoke in India, you like high quality names. Name a few for us.
Absolutely, Nigel. So Europe is really interesting. I came into this year optimistic on Europe, particularly banks and defense companies. And I think the story for Europe is one that's still characterized by central bank easing. So financial conditions are going to get easier across continental Europe. You have growth that has likely bottomed. We're probably going to see trade deals come, but what's most important to, I think, the European story is the fiscal impulse you're getting from countries like Germany that have committed 500 billion plus euros to rearming the continent. So I think the defense play has a lot of legs to go, even if you do get ceasefires. So I think there's a lot of good investment opportunities across continental Europe. Again, I might want to lean into financials, defense, perhaps some consumer-oriented companies more in the luxury goods space, and avoid some more of the names that are still tied up to China, because that's an area that I think is going to suffer from dislocations, at least in the short to medium term. You flip to countries like India, some of my favorite names, my biggest overweight by far right now is still ICICI Bank. That's been a name we've talked about a lot. I think it's the highest quality private bank in the country. You've seen really, really strong earnings. You've seen net interest margin strong, loan growth improving. There's really not much not to like about the stock going forward. So again, I would use any sort of dips opportunistically. And other names that I had been accumulating kind of later in the year on some of market weakness, like HDFC Bank, they've also reported very strong earnings, net interest growth, and they're finally starting to see loan book growth, which is a really encouraging sign about the Indian economy and the state of their business as well. And another name that I lightened up maybe a little bit too much that I think I might look to add to that reported earnings yesterday was M&M. Mahindra & Mahindra reported really strong earnings. I liked the growth, the surprisingly strong growth in the tractor segment. You're seeing them in a really strong SUV market cycle. So again, that plus some of the mergers that they're starting to do, that looks like it could be a continued growth story to me.
All right.
Yeah, absolutely. In fact, Matt, we spoke with the management, the M&M management. They were here in the studio yesterday. And indeed, that's what we were quizzing them. They seem to have found that sweet spot between volumes, pricing, and how do you get that margin up and about as well. So, yeah, M&M was quite the stock yesterday.
Absolutely. And Matt, it's always great speaking not just macros, but stock-specific stuff with you as well. Thank you very much for joining us, Matt.
Thanks.
Great conversation, as always.